Good morning, everyone. Thanks very much for joining us at short notice in really interesting times. I wrote some notes last night before I went to bed, and I thought, oh, good chance they'll be mostly wrong. Little did I know when I woke up this morning they'd be almost completely wrong. So a few changes just to start with. Unfortunately, Gurpreet from Goldman Sachs has come down sick and won't join the call. So our format today will be a tad shorter. Shortly we'll go to Matthew Johnson, then we'll go to Michael Sherrock, and then finish with Alan Clarke. Matthew will lead out with just some brief comments on the OCR from yesterday. All the presenters are staying online for the whole call, and the objective is to run through in about 15 odd minutes and to take your questions. You can ask questions two ways, either by using the chat function, or many of you will have my email in your email inbox anyway. So nothing further to say by way of introduction. I think we'll just come straight to you. Thank you, Matthew.
Hello, Stu. Good morning, everyone. Well, yesterday we had our first OCR review decision under the governorship of Christian Hawkesby, and as universally expected, the Reserve Bank delivered a 25-point cut, taking the OCR to 3.5%. That's some 2% off its peak. But perhaps more important than the cut decision itself was the content of the statement and its rhetoric. The things that we were keeping an eye on were for comments around the downside risk to domestic growth and that of our key trading partners, and for the Reserve Bank to highlight the significant uncertainty it faces and that it's going to keep its options open and observe the data and respond in due course as things are more clear. And both of those items were soundly delivered upon. Now, much like Stu, yesterday I had my thoughts together as to what I was going to say today. I woke up this morning, did my usual check of the markets and the headlines, and lo and behold, the landscape had entirely changed. We now have 10% tariffs being applied to all nations, ex-China, and a 90-day delay before those come into effect. And to me, this is just really symbolic of the uncertainty that markets and companies are facing. This ever-changing tariff regime is certainly not going to be supportive of business investment decisions, and that's going to be negative for growth. But stepping back a little bit, more broadly related to tariffs, the things the team here at Nikko are thinking about are, one, what is the primary impact tariffs are going to have on prices? Two, how will tariffs impact our domestic growth and that of our key trading partners? And three, how will tariffs impact company profitability and investment decisions? Now, in relation to those first two items, their impact on inflation is highly related, and there are both inflationary and deflationary components at play here. On the deflationary side, we have lower oil prices. We also have the potential for trade flow diversion from foreign markets into New Zealand. Running contra to that, we have a New Zealand dollar that has depreciated, and all else equal, that's going to make our imports more expensive. But even there, it's not a one-sided story. A depreciation of the New Zealand dollar is supportive of export earnings. It is also going to make New Zealand a cheaper destination for tourism, and both those things are great for growth. When I think about our key trading relationships, the largest two are with China and the US. When it comes to China, historically, in periods of soft growth, they've used fiscal stimulus, particularly targeting infrastructure spend. And we expect a similar playbook this time round, but arguably they've already spent a lot on infrastructure, so perhaps this time they're going to focus more on encouraging domestic consumption. And should they do that, New Zealand's going to be a net beneficiary. We sell China meat, seafood, wine, and milk-derived products. All of those are going to be supported by increased domestic consumption. When I look across to the US, the key exports in order of importance we sell there are beef, wine, sheep meat, and milk-related products. Now, all of those face a 10% tariff. That is, however, partially offset by the depreciation of the New Zealand dollar. It was down some 5% yesterday, perhaps slightly less today. Nevertheless, there is an offsetting factor at play. We also need to remember that the US buys those products from us because it can't produce them in sufficient volume domestically. Agricultural goods and horticultural goods are not like a manufacturing line. You can't simply run an extra shift and produce more overnight. So the US needs to buy that from a foreign nation. And in terms of tariffs, New Zealand is no worse off than any other nation. So I'm thinking demand is going to be reasonably inelastic for those goods, and the US will continue to buy them. Wine, look, that's a slightly different story, but I think a lot of the similarities are there. When it comes to wine, there is no direct alternative good available in the US. You know, a Californian white is simply not the same thing as a New Zealand Chardonnay. And, you know, wine buyers, they're making a very active decision to buy New Zealand wine. Provenance is important. Their view on flavour is important, as is label. So again, in light of the relatively small tariff at 10% and the offsetting impact of our currency depreciation, I think we're going to see inelastic demand there as well. So look, in closing, tariffs, yes, they're going to be negative for growth. They're going to be negative for company profitability and investment decisions, and they're probably going to have a downwards impact on inflation. However, from a New Zealand context, I do think we're probably better off than many other nations. Our trade is reasonably diversified, and as I talked about for the US and China, there are some offsetting factors at play which will see demand for our goods continue. I'll pause there, Stu.
Thanks very much, Matt. Just because I can see the numbers who've joined online, just a couple of things for those later joiners. Zip through any questions you've got via the chat or directly to me on email. Also, this session is being recorded, so if your colleagues couldn't make it because it was short notice, just let us know and we'll zip through the recording. We'll go on. Thank you very much for that, Matt. That's awesome. Matt will be around for questions at the end as well. But we're going on to Michael Sherrock. Oh, sorry, just one other point. The later joiners, I did say that at the start that Gurpreet from Goldman Sachs has come down ill and is not joining the call. So there's 3 presenters today. So over to you, Michael Sherrock.
Thanks, Stu, and some good stuff there from Matt. I covered a few areas that I was going to talk about. But just thinking about the New Zealand market, the impact of tariffs is actually pretty limited. Delegates, Matt touched on the wine exports, Scala up. Kathmandu has about 20% of its sales into the US. And then the big one, Fish and Paykel Healthcare, largest stock in New Zealand market, has a big chunk of its production sent to the US. A lot of that is from Mexico, and heading into this tariff debacle, you could say, the market was expecting that production from Mexico would face a 25% tariff. At this point in time, it is exempt due to the US, Canadian, Mexico trade agreement. So that's a little bit of a win from where the market was thinking initially, albeit the production from New Zealand is still caught up in that 10% tariff. In terms of the indirect impacts on the market at the moment, it's really around negative sentiment. Essentially selling equities, buying, or moving into cash. So risk off is the area there. And then a global economic slowdown will no doubt impact on New Zealand to some degree. But as Matt touched on, our goods that we sell, the soft commodities that we sell, are very sought after globally, and the US just can't stand up production of more cows or apples or dairy beef, whatever they demand. So even if the US decided not to buy our goods, there is a home elsewhere in the world for what we produce. It is very well sought after, and the lower currency versus the US dollar may actually mean that some of our producers are slightly better off in New Zealand dollar terms. But just thinking about the New Zealand market anyway, we are a very defensive market. A lot of what we produce is produced in New Zealand and sold into the New Zealand market. So the impact of tariffs for a big chunk of the listed market is irrelevant to, you could say. If you think about property securities, the Kiwi Properties, the Goodman Property Trust, the precincts, the gentailers, so that electricity sector, Contact, Meridian, Mercury, Genesis, all produce and sell into New Zealand. Auckland Airport's an interesting one. Does global growth slow down? Does that mean less tourism coming into New Zealand? The counter could be the weak dollar means that New Zealand is a attractive destination to come to. If you're sitting in the US and you want to escape things for a little while, maybe New Zealand is a great place to come to and will be cheaper. So that is something to think about. The New Zealand market is also a very interest rate sensitive market. So with the 2% cut in the OCR that we've had from the peak, the extra 25 points yesterday, that does make some of the companies in New Zealand with high dividends more attractive. So we're thinking about some of those names that I just mentioned: the property sector, the electricity sector, high distributions and attractive dividend yields are a good thing. And then around liquidity in the New Zealand market, we haven't seen a change in liquidity. The value trade in the New Zealand market has been pretty similar to normal days. There's been certainly more intra and inter-day volatility, but as I say, liquidity has not been a problem. Market was down about 3.8% month to date. Before the US recovery overnight, the US market was down 11% or thereabouts. We should expect a reasonable rebound in the New Zealand market today as well, all else being equal. I'm not sure what Trump has said while I've been on this call, which may change everything I've just said, but we will see. But things are heading in a slightly better direction. So I guess in summary, the listed market in New Zealand has very limited impacts from tariffs. Earnings are defensive. The OCR cut is helpful for the sort of higher dividend nature of the New Zealand market as well, making it more attractive. And if we think about the likes of term deposits, which were at 6% not that long ago for 6 months, now around 4%, that could head towards 3% as the OCR continues to be cut. And just may make the New Zealand equity market slightly more attractive as well, in terms of people looking to maintain their incomes in relatively defensive earnings and also high dividend yields. So that's it from me. We may have more to say as I end this call, and things may have changed.
Thanks, Michael. That's great. Hey, just answering a question that's offline. Yeah, we are recording this session, and we will make it available so you can share it with your clients if you want to. So that's thanks for that question, and do appreciate you can probably see the Q&A that's lining up off to the side. Thanks for that, Michael. We will go on to Alan Clarke. The floor is yours, Alan.
Morning, everyone. Thank you, Stu. Yes, very interesting times, like Matt and Michael said. So, like the others, I had prepared to try and talk about what we were looking in terms of an outlook, and I'll just try and update that with the latest announcements. So just to step back a little bit, of course, as everyone knows, it was really April the 2nd where this, instead of an update from the US administration on some widely expected tariffs, there was the ridiculous blackboard or the meat board that they held up with huge reciprocal tariffs across just about every country they do trade with. So, and that has led to one of the most remarkable weeks we've seen. We keep talking about COVID being unprecedented. Parts of the GFC were unprecedented. And these moves we saw late last week in global equity markets and global bond markets, or global equity markets in particular, were, for the likes of the US S&P 500 down over 4.5% back-to-back days. That is very rare. The VIX, the sort of fear index, the price of buying protection, if you like, against equity falls was spiked up to above 60. So again, back to those levels we saw in 2020, back to those levels that we had to get used to in the GFC, which of course played out over many months, not a couple of days. So attend to some more stats for you to enjoy. A 10% correction apparently happens in US equities every 34 weeks, but they usually take a matter of months. So here we had a 10% correction in just 2 days. And of course, as always with these massive moves, volatility begets volatility. So we know there are a lot of funky esoteric strategies out there involving leverage, and a lot of those strategies have to be quickly unwound, which of course brings more selling, which of course brings more unwinding. So it has been a crazy few days anyway, and some announcements from the various governments responding to this sort of reasonably aggressive stance on global trade. And then, of course, just a few hours ago, an announcement from the White House that they would be pausing for 90 days on just about every country in the world. They are talking proudly about 75 countries who have reached out to them. And they're going to be pausing those reciprocal tariffs, which again, as every country worked out, were just made up numbers based off their trade deficit. They were not really to do with or how they got to the numbers was not really any sort of fine bit of economics. It was just a finger in the air exercise. So they are at least going to be paused. Still have this 10% global sort of tariff, if you like, which was more in line with what was expected to be announced April 2nd. And what we've seen, of course, is the equity market, well, the US at least, is sort of up again, a move that we hardly ever see except in times of those, except in March, April 2020, except in times of the GFC, nearly a 10% move in the S&P 500 higher. And ironically bringing us back to where we were, close to where we were just before April the 2nd announcement. So I'll try and sort of cover a little bit of what we think we might have learned in the last few weeks and months, and what does that mean. We know that Trump is happy to use unorthodox policies. It did feel like the first announcement. Again, there's lots of course, insiders who think they know what's happening and what's not happening. He does seem to have pulled together a tight team, and that first announcement, it seems like it was really thought up in the last 24, 48 hours. This was not a well mapped out policy with lots of consultation, lots of what will be the expected impacts, what will be the unintended consequences. It sounds like they dreamed it up over the weekend and rolled out the blackboard for the world to see. And likewise, even this rollback was kept reasonably tight. There was a leak on Sunday, which they quickly, around this being just a negotiating tactic, that was sort of, but apart from that, it was kept reasonably quiet. But again, it feels like the policy here has been reactive. So we could sort of assume that even Trump has a pain threshold. The stock market was down, as I said, unprecedented, sort of very unusual amounts. He does like to use the stock market as a gauge of his performance. So one thing we can keep thinking and reminding ourselves of is, do we think he wants the S&P higher when he leaves the office in 3 or 4 years' time? And I think the answer to that is yes. Does he want a stronger US economy? Yes. And does he have a pain threshold? Yes, he does. The bond market, of course, bond prices initially rose, yields fell, as is normal with a big equity correction, but then they had moved higher over the last couple of days on those fears that this would trigger a big inflation problem for most of the world and for the US. So the mighty bond market, that everyone should be scared of if you're a politician, that may have tempered his, or at least forced his hand. And of course, even his allies in Congress, as political allies, they also, they've got constituents complaining about some of this sort of massively sort of ground-shaking approach. It's one thing to try and bring some jobs back to your country, to try and do it with one fell swoop and one announcement. Everyone, a lot of parts of the states realize this is a long-term play, and it's going to do. If it does more harm than good initially, there will be political pushback, and he would have felt that as well. So where we stand from here, we're still trying to do the same thing we always do, which is assess what does this mean for the fundamentals of inflation, growth, and interest rates. When the announcement came out a week ago, again, a lot of folks would have modelled this up. The sort of, if implemented as they were with massive tariffs, 20 plus, 40 something for Vietnam, all those tariffs, the sort of expectation was you could have taken more than 1.5% off global GDP. So that's a pretty brutal drop. Global GDP in a sort of good normal year might be doing 3.5, 2.5, 3. So taking 1.5 is brutal. Even for the US, this was sort of modelled up as maybe a 0.7, 1% off GDP. Back to the sort of expectation of a 10% tariff with lots of negotiation. That's still expected, but that's expected to be more like 0.2, 0.3%. So again, a drag to GDP, but not that brutal pull, not that sort of brutal adjustment lower, which would have effectively been or felt like a sort of global recession. So the chance of that global recession has gone down. It has not gone away. And also with inflation, again, this is these moves, the impact they'll have on supply chains. It's the central banker's worst nightmare. It's like COVID again. You'd have a supply shock where prices have to go up, but it's not because of it's an inflation, not because demand is strong. It's because it's hard to get your hands on goods, and that's the ones the central banks really struggle to. Raising interest rates is just going to cause a recession. So the Fed is still in a tough spot. Mr. Chair Powell had to speak on Friday, which was a terrible time for him to be speaking, sort of literally 24 hours after this announcement, but he did a reasonable job, as always, of sort of staying the course. They have to wait and see what the data looks like. They have to wait and assess. They have to wait. They've got their dual mandate. They need to keep inflation expectations anchored, but they also have to worry about the labour market, unemployment, the economy. And this very rapid change to the world trade order risked those inflation moving higher, growth coming sharply lower. So those are now a bit more manageable. And one question, which of course the Fed will have to answer, there is still expectations they cut rates this year. And would they do that if the economy was weakening, even if you had inflation at 2.83%? I think the answer is yes. Sometimes it's good having a dual mandate. You could argue it makes it difficult, but if they see the US economy weakening from an uncertain consumer and uncertain business environment, that would be enough for them to bring rates lower as well, like we saw yesterday from the Reserve Bank of New Zealand, like we expect to continue seeing with other central banks. So, long story short, uncertainty is still massively high. The announcement last night is sort of takes us back to what I guess was expected. It doesn't remove the uncertainty. It doesn't make it very easy for a business or an industry or an individual to plan their spending. And that in itself is a problem. It can become a problem in sort of aggregate economic growth. So, but yeah, good to see that there is a pain threshold even for the sort of this radical new administration. So one more thing I should mention. The other one we might have learned, whether this was always the plan or not, but China, of course, has been signalled out for special attention. It may have always been the plan. No kidding, the US is the biggest economy in the world, 25% of global GDP with 4% of the population, which is pretty impressive. And no kidding, their big threat to their sort of hegemony they've had since World War II is China. So whether this was always part of the plan, the initial tariff announcements, the brutal ones, seem to focus on China and Asia. The latest last night, China has still been signalled out. Was it because they retaliated, or was it because they were always going to be? And again, that is still US and China having a tit for tat trade war is not good for global GDP. It's not good for certainty. It's not good for running a business. So that still remains. How that plays out will sort of contribute to that volatility we expect to see.
Awesome, thanks, Alan. Yeah, we've got a few questions online, and appreciate some people can see a few of those answers being knocked away. Maybe I'll come back to you first, Matt. Just a couple of things on interest rates, if we could. So, given New Zealand's isolation and perhaps relatively better outcome at this point, at least on tariffs, stable economy, etc., demand for safe haven bonds, how's New Zealand placed? And also, could you just carry on to implications for mortgage rates in New Zealand? And if you don't mind, finish with a bit of a currency view, if you can wind all those together. And sorry to put you on the spot, but that's what we've signed up to, it seems.
Sure. Look, I'll start off with our view on interest rates. Since these tariffs were announced and the turmoil happened, what has happened to the market? Well, pricing for the OCR has started to factor in risks that it goes lower than previously expected. Markets are putting 275 in play and possibly lower. Look, we need the data to develop to see whether that's going to be delivered or not, but it's certainly quite aggressively priced there already. As we look out the curve towards the longer end, particularly in governments, yields have actually gone up. And if you do believe that the front end of the curve is going to continue to come down to at least 3%, then the slope out to the back end of the government curve is really attractive. It's a really steep curve, steep compared to history, steep compared to other markets globally. And we like that as a bond manager. particularly in the lower risk sectors, including our risk-free asset governments. So to me, this is a great opportunity to look at increasing positions in the long end of government exposures. In terms of mortgage rates and views there, look, you've previously, for those of you who've listened to us before, you've heard our recent views on mortgage rates. We believe that the rates there in the market today at 2 years, at 1 year, are actually quite attractive. And I don't think that story's changed. There's perhaps a little bit more room for them to fall, but the important bit is it's a little bit. When I look today, I see 1 year swap is around 3%, 2 years around 3.15. Again, a 4.99 mortgage at 2 years, that's a spread of under 200 points. Historically, that's not either wide or tight. So there's a little bit of room for a fall, but not a lot. It was already reasonably priced. And it's the exact same story at 1 year. We've seen reactions from banks post the OCR. Where did they cut? Not those 1 and 2 year rates. They cut the floating rates, as that's an easy one to do. Look, currency, that's a really difficult one to come through. You heard Michael talk about how New Zealand's not actually that bad off, that we have quite a strong domestic focus, that our goods are still going to be in demand. All that suggests that NZD should actually perform. Yet we do know in times of global stress, New Zealand is seen as a risk currency and typically will just get sold and depreciate. So look, I think we just need to wait and see how that develops over time. I'll pass back to you there, Stu, for any further questions.
Cool, thanks. You can take a rest for a moment. I think the next one's coming to you, Alan. I guess the obvious question out of all of this is, does it change anything to do with asset allocation for the funds? So interpret that as you will. The literal question was, have we changed asset allocation positions in diversified funds since the first tariff announcement? So if you just take that as you please. Thanks.
Yeah, good question. So no, we were broadly neutral going into this, which was frustrating, of course, a week ago when it, with hindsight, it's an easy game. We should have been more defensively positioned. In saying that, we've been sort of at neutral for the last sort of year and a half, thinking about, is this cycle going to be extended? Are we going to have a recession? So we sort of always try and step back a bit. But likewise, when we had the correction, as always, we can make 3 decisions. We can sell some risk, we can do nothing, and we can buy. So we did take the opportunity early in the week to buy. That's sort of just a bit of a rebalancing discipline. So make it for a growth fund. You're buying a few percent of equities. On that move lower, the VIX is above 60. You just about always that. Again, if you can separate yourself from the noise, that's just about always a good time to buy, at least in the short term. Never very pleasant at the time. We're not going to say we were expecting this massive walk back, but we did. That's the good thing about having our strategic asset allocation and sort of our neutral position. There is a forced discipline there to rebalancing back to that, or to take it back a step. If we fall below our neutral targets, we ask ourselves, are we comfortable being down, below risk, below underweight risk? And if not, we buy. And that's the good thing about these horribly volatile times. That sort of neutral position, we're always asking ourselves, are we comfortable being away from that? The next, as always, we've still got the same question ahead of us. Is this a time to take on more risk, to reduce risk, or to stay effectively neutral? So again, we wouldn't usually make large position changes like taking a big overweight or a big underweight when the market is so crazy, when these announcements are coming out reasonably sort of ad hoc manner. You sort of are having to play the person and not the long-term game. But in terms of that, the bigger question, do we think this is going to bring about a US and or a global recession in the next sort of 18 months? I still think the answer to that one is no. A slowdown, yes. Reordering, a tough time, yes. But that the market has moved, had already moved from the middle of February to start pricing some of that in. So we could be back to that 2023 scenario where there is fear of a recession. Equity markets have moved lower, and not like we saw last night. Less bad news is good news. So there still is this possibility that this does present a longer term opportunity to go sort of more overweight risk. Now, the good thing about our approach here is we don't look to time that perfectly and pick the bottom. We are just trying to think, we're sort of trying to think, what's the equity market, what is the world going to look like in 6 months' time? Because the equity market is pretty good at moving to that. And if in 12 months' time, we're going to have a more normal world, or at least not these 50, 100% tariffs everywhere, that's the recipe for a higher move, higher in equity markets.
Thanks, Alan. Great answer. Hey, just by way of insight to those online, so lags happening in the market. So what we did as a group, as the investment committee, was to sit down on Tuesday morning and just have a conversation about how we saw everything. Of course, as you'd expect, there's conversations going on over the desks all the time, but sit down more formally once all the markets had a chance to open. Michael Sherrock, I'm just coming to you next. The question that I have is just obviously maybe just talk a little bit about exposures within the portfolios, New Zealand versus Australia. And do you think it's a markedly different outlook for Australia with their tariff outlook, or is it broadly similar to New Zealand? Thanks.
Yeah, I'll start with the second part of that first, I think. So Australia is more exposed to what's going on in tariffs around the world. If we think about the resources that they produce, sell a lot into China, and whether it's turning iron ore into steel, the end result is some of that would be exported to the US. It would be turned into other goods which would be sold into the US. So some of that demand may change. Pharmaceuticals facing tariffs as well. So certainly the Australian market is much more hard commodities, so resources that they're exporting around the world, which are more susceptible to what's going on versus our soft commodities in New Zealand. So that I think that is probably the key difference between New Zealand and Australian markets at this point in time. And you see that through the equity market returns. The Australian market sells off much more aggressively than the New Zealand market did as well on those big days. Within our portfolios, some of the names that we've got, ResMed is one that is impacted, albeit 40% of its production is in the US. It also has Singaporean and Australian production. So both of those countries at the moment are facing lower tariffs than some of the hard hit Asian countries, or what were hard hit Asian countries, apart from China, which remains in that position. And then we've got a couple of property names, so Ingenia Communities and Waypoint REIT, which are Australian only exposures. And then probably one of the bigger ones and has been hit somewhat harder than other names is Worley, so engineering services globally. What we get with uncertainty is, just markets hate uncertainty. Companies hate uncertainty when they're making investment decisions. So, what that might mean for Worley is some of the projects that they may work on in the future are delayed or take a little bit longer for companies to make those decisions. But I do think if we do end up with a 10% tariff across the board, the world knows where they're sitting. Companies can move forward with their investment decisions. And that provides a lot more stability, and decisions can be made. So I think that would be the better outcome. Is just we know what we're doing day to day. Whereas over the last week or so, every day has come out with a different situation, a different set of tariffs, a different possibility of what might come from the president and out of the US. So that uncertainty has been disturbing for markets and companies making investment decisions.
Great, thanks, Michael. I'm not sure who would like to take this question, but I think it's just a confirmation. I think it is the percentage of Chinese exports that go to the US. Now, if someone knows that number, suggested online, it might be 15%. I'm not sure if someone already answered or said that. So anyone want to take that one?
I don't know that one off the top of my head. It's, as I'm assuming Mr. Trump's right, they talk about the China imports 5 times as much to the US as vice versa.
Right.
But that doesn't answer the question. But that's the sort of thing he's looking to address now. Of course, in practice, what is China going to buy off the US? That's 5 times what they currently do. I don't know.
Yeah.
That was not even a politician's answer. That just made up a different question.
Yeah, well done. I've just had it confirmed via text on my phone, so that's all good. Oh, I've got a lot of engagement on this. It's a good one. Hey, I think this one's going to come to you, Matt, and just fair warning, I think we said we'd go 45 minutes. So if you keep asking us questions, we'll keep trying to answer them. So go for it. The question is, given the uncertainty in US policy, is there danger that Treasury demand wanes? I mean, it's sort of the converse of what I was asking you about New Zealand, saying that, we've got a more certain policy here, therefore our bonds should be well sought. So the second part of the question is, could be a real issue with rising debt after proposed tax cuts as well. So maybe just that US view, if you could please, Matt.
Sure. Look, I think everyone around the world is really aware of the unsustainable deficits the US is running. However, we should also remember that the Fed is there to step in periods of extreme stress. Their balance sheet has actually run off a fair bit since the COVID uprun. It got near 9 trillion in size. It's now back below 7 trillion. But perhaps more important, as with many economic data points, you should probably put that in perspective of the size of GDP. So the Fed's balance sheet, it peaked around about 35% of GDP. It's now back into the low to mid-20s, around 22, 23%. And that's not an unusual level of balance sheet size. It's actually similar to what we had before COVID, where they were between 25% back in 2014, and then they were actually declining towards 2019 before COVID. So there is significant room for the Fed to restart QE. But yes, it is definitely a risk that we could see some volatility there, but the Fed will be there to step in that extreme stress scenario.
Yeah,
maybe one more on that as well. If we think about what was the administration trying to achieve, a lower, no kidding, if they have a lower US 10-year or lower rates, of course, it makes their debt, servicing costs lower. So initially, the reaction with equity markets down is always bond yields fell, and maybe they felt pleased, US 10-year down below 4. But of course, a combination, as the markets reassess all the different expectations for inflation and what does it mean for economic growth and what does it mean for do I want to own US treasuries? The treasury market, of course, the US 10-year goes back to 4.5, and suddenly this is getting into the scary time. Oh my God, our debt servicing costs are going to go up. So as I think Clinton had an advisor who had that great phrase in the 90s, I thought I wanted to come back as a baseball player, but I want to come back as the bond market because you can intimidate anyone. So even this administration has learned that you cannot dictate where the interest rates are going to go. The British government found this out in the last 2 years with that aggressive budget. If you have a sort of buyer's strike, no one wants to hold your debt, you've got a problem. And the US has a lot of advantages: reserve currency, safest treasury market in the world, but even they are not immune to if their policies get too outlandish.
I'll just add one extra thing to that. When you think about the staging of Trump's policies, they were always designed to bring the tariffs in first, so he could see what revenue was generated, and that would be what allowed that reduction in tax rates without it being a complete risk event. So, that phasing is still in place, and perhaps there's going to be some adjustment around those tax levels depending on what comes in.
Yep. Okay, that's good. It actually covered off a question we had on online as well, which was just whether the US risked losing their reserve currency status. So yeah, I think that would be a frightening aspect that even President Trump would perhaps be challenged by. Maybe one last question just to close. Just checking online. Yeah, Alan, we were talking a little bit before this call about further down the road. Are investors forced into a stark choice between either supporting the US or the Western bloc, if you like, versus the Chinese bloc? How do you think about that? And admittedly, it's asking you an impossible question, but we know you like that sort of problem.
Well, yeah, that would be one of the long-term risks of if you got two mighty empires battling for that status as the number one player, then I don't know. There's a few examples through history where it can get nasty. So the picking on China, US versus China is going to be bad enough. That's still unless somehow they can find a way to negotiate, and of course they've made it difficult for themselves by getting to the negotiating table without losing face. But an extreme would be the US. If the US started demanding their allies do business, do trade with them and their allies or China, that would, New Zealand New Zealand and many open economies around the world have business with both. And at the moment we're insulated, and that's great. So an extreme and negative scenario would be that you have to pick and choose. Do I want to trade with China or US and their friends? I don't think we're there yet. That would typically play out over many years, and would be to think about how that would be enacted as a policy. But it would unravel sort of decades of this sort of coordinated global trade, which just about every sensible economist thinks has been beneficial for many parts of the world. But as we're seeing with this new administration, they don't mind trying things on the fly to see how it goes.
Perfect. Thanks, Alan. I think we will draw it to a close now. So thanks everyone for being available. We'll send out the recording if you're interested in that. So just reach out to the distribution folk. I thought I'd try and finish with something pithy, so I went looking for a quote. Alan's got a worried smile on his face. So the quote I chose is, "The stock market is a device to transfer money from the impatient to the patient." That's from Mr. Buffett. And I think that seems reasonably apt. I think you could interpret the stock market to be the market as well. So we are patient and considered investors. We thank you for your support, and if you find value in this, then we'll certainly do it again if the stuff that's coming out of the US warrants doing it again. Thanks very much, and have a great morning.